All right, let's jump right into this explainer. Today, we are putting advanced manufacturing giant Flex to the absolute test. We're running it through the ultimate valuation gauntlet, using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Now, Flex is smack in the middle of this massive global AI infrastructure buildout. It's a great story, right? But does a great narrative actually equal a great valuation? Well, let's find out. 54.1. I really want you to just sit with that number for a second. That massive figure is Flex's current price-to-earnings ratio. With a market cap hovering around $47.6 billion and a stock price sitting over $127 a share, the market is pricing in a frankly tremendous amount of future success. So our job today is to figure out if the underlying cash flows can actually support that kind of heavy expectations. To understand all this hype, you really don't need to look any further than this quote from CEO Revathi Advaithi in her 2026 shareholder letter. She hits the nail on the head. AI, regionalization, surging energy demands, they've completely rewired what Flex does. They aren't just some low-cost electronics assembler anymore. They are literally building the critical power and cooling infrastructure that the entire digital economy runs on. So here is our game plan. We'll start with a company snapshot and the Buffett lens, move to Peter Lynch, then Benjamin Graham, run a DCF valuation, look at alternative models, and finally, bring it all together in our synthesis. Okay, moving right into section 1, the company snapshot and the Buffett lens. When Warren Buffett looks at a company, you know he's hunting for a widening economic moat and a top-tier management team. And honestly, CEO Revathi Advaithi has driven an incredible strategic transformation since she took over. She totally gets that complexity is what makes a manufacturing business defensible. Under her leadership, they spun off Nextracker, which unlocked a cool $3.5 billion in value. And they just recently announced they're spinning off their cloud and power infrastructure business, too. This lets it run faster as a pure-play AI infrastructure stock. That kind of disciplined portfolio management, it absolutely widens their moat. And they pass Buffett's qualitative tests with flying colors. Just looking at the raw financials, their return on equity is a really solid 17.1%. That's $880 million in net income generated off of $5.14 billion in equity. What about debt? Well, they've got $4.32 billion, but it's totally manageable because they're pulling in over $1 billion in free cash flow every single year. For Buffett's famous owner earnings metric, we're explicitly assuming their impressive $1.05 billion in free cash flow serves as our proxy. Toss in 6 consecutive years of double-digit EPS growth, and the business itself looks incredibly strong. But here's the catch. Buffett loves a great business for sure, but he demands a margin of safety. He wants to buy a dollar for 50 cents. Paying over 50 times earnings for a manufacturing company, even a super advanced one, simply doesn't fit those strict criteria. The verdict here? It is a wonderful company, but absolutely not at a wonderful price. He'd definitely wait for a steep discount. All right, let's shift gears to section 2, the Peter Lynch lens. So, Lynch famously championed the PEG ratio. He was always looking for that sweet spot where a company's growth actually justifies its valuation multiple. Think about it like this. If a company has a PE of 20, but it's growing its earnings at 20% a year, the PEG ratio is exactly 1.0. Lynch considered that fairly valued. Anything below 1.0, that is the holy grail for a Lynch investor. First things first, we have to categorize Flex. Historically, it's been a classic stalwart. Steady, reliable, maybe a little boring. But this recent pivot into AI infrastructure, that pushes it firmly into fast grower territory. They are providing the essential grid-to-chip power stacks, the thermal management, the switchgear, the liquid cooling, that frontier AI models absolutely require. This pivot is exactly what has Wall Street so incredibly hyped up. But here is where the rubber meets the road. With that 54.1 PE ratio and a 5-year average growth rate of just 7.5%, the PEG ratio sits at a massive 7.21. Now, we don't have current insider trading data here, so we're assuming a neutral stance on that. But even looking at their record-breaking 2024, where they cracked $1 billion in net income, their historical growth average simply cannot keep pace with this ballooning stock price. Honestly, Lynch would likely take a hard pass here. A PEG over 1.0 is a glaring red flag, and 7.21? That is so far beyond a reasonable price for its historical growth. You are paying a massive premium today for growth that just hasn't fully shown up in the bottom line yet. For a pure Lynch investor, this is a clear-cut sell. Moving right along to Section 3, the unforgiving Benjamin Graham lens. Graham is the ultimate deep value guy. Running Flex through his defensive checklist, it passes on sheer size and earning stability without breaking a sweat. But it fundamentally fails his strict requirements for dividends and moderate multiples. Graham wanted a PE below 15, Flex is at 54. He wanted a price to book below 1.5, Flex is over 9. Plus, they pay absolutely zero in dividends, not a cent. They opt for share buybacks instead. And let's actually do the math here on his famous intrinsic value formula. We take the square root of 22.5, multiply it by their $2.33 earnings per share, and multiply that by their $13.74 book value per share, which, just to clarify, is their $5.14 billion in equity divided by their 374 million shares. The result, a price of just $26.83. The math is called, it's unforgiving, and it shows Graham's intrinsic value is completely detached from the current market reality. At the current price of $127, Graham wouldn't touch this stock with a 10-foot pole. It offers zero margin of safety for the defensive investor. The market is pricing Flex almost entirely on future expectations, which is literally the exact opposite of Graham's philosophy. All right, Section 4, Discounted Cash Flow Valuation and Projections. Let's look forward. Looking at Flex's recent net income trends, we get a really nice, conservative baseline for our cash flow projections. While 2024 was a peak year, crossing that billion-dollar mark, 2025 and 2026 settled down a bit into the mid-800 millions. But their free cash flow remains an absolute powerhouse, crossing $1 billion for 2 straight years and hitting $1.05 billion recently. So we're going to use that $1.05 billion as our starting point. Since the provided data doesn't explicitly give us a discount rate, we're going to assume a standard industry average of 10%, along with the 2.5% terminal growth rate on that $1.05 billion free cash flow. What does that give us? A fair value per share of right around $55. And hey, even if we're super generous and adjust for this whole AI boom, say dropping the discount rate to 9% and bumping terminal growth to 3.5%, the model still tops out around $72 a share. Standard cash flow forecasting just cannot get us to $127. Let's look at a few other ways to slice this in Section 5, Alternative Valuation Models. If we explicitly assume broad tech hardware sector peers, comparable multiples put its fair value near $95. But check out the reverse DCF. This is wild. To justify the current $127 price through cash flow alone, Flex would need to grow its free cash flow by nearly 18% every single year, forever. Let's be real. That is incredibly difficult for a capital-intensive manufacturing business. Oh, and the dividend discount model? Completely off the table here, since they return capital entirely through share repurchases, like the $944 million they spent on buybacks just last year. Finally, Section 6, Synthesis, and our final recommendation. Let's bring it all home. Here is our master scorecard, and it paints a very clear picture. Flex is an operationally superb company, but at $127.34, it fails practically every traditional valuation stress test we have. Buffett would want a massive haircut down to around $75 just to find a margin of safety. Lynch sees a completely detached PEG ratio. Graham is absolutely terrified of the multiples, and the DCF modeling shows the stock is priced for absolute perfection. So the final verdict? It's overvalued. We are looking at a strict sell for any value-conscious investor right now. Which brings us to the ultimate question for you. Knowing the immense, very real growth happening in AI infrastructure, but comparing it against these rigid, unforgiving financial realities, at what price does this stock finally enter your personal margin of safety? Is the premium worth the revolution, or are these fundamental guardrails there for a reason? Think about where you draw the line. Thanks for joining me on this explainer, and keep questioning the numbers.